Welcome back. In the previous video, we looked at the internal rate of return, a very useful measure. It is also often the basis of the good alternative to the net present value for deciding what projects to take. In this video, let's consider a few capital budgeting rules that can go badly wrong. Why? Because they're in use. I've heard some managers even opine to me that they use them because they are more practical and less egghead. However, mostly other capital budgeting rules are often just simply more stupid and scrambled in the membrane. In fairness, some rules are based on metrics that can offer useful information. They just shouldn't be used primarily for deciding what projects to take. I'll also spare you the truly dumbest rules. I will just describe a few half-dumb ones that are in very wide use. Still, and most important, you need to understand how to respond if someone else proposes using them. I will not be asking questions or tests about them, but I want you to have seen them. You really only need to be aware why they can be badly misleading rather than learn how to use them. No other rule is used more in practice than net present value. The runner-up is its cousin, the internal rate of return. Other capital budgeting rules are set sometimes occasionally to help intuition. They can only either be redundant or wrong. Some are in use, so you should know about them, but that's it. Sometimes they can be useful, especially in an imperfect capital market, which we haven't covered yet. Two more capital budgeting rules that I want to discuss are the profitability index and the payback rule. There's also many other worse rules, but let's forget about them altogether. I've heard managers opine that some of these other ones are more practical and less egghead. However, mostly they are just simply more stupid and scrambled in the membrane. I will spare you the dumbest. I will just describe these two half-dumb ones, and I will not be asking questions on the tests about them, but I want you to have seen them. Here's the profitability index. A project costs $13.16 million. It pays $7 million next year, $8 million the year after. The profitability index is the present value of future cash flows divided by the cost, made positive. So for this project, here is the example. If R is 20%, and I have to use the R 20% in the numerator, the present value of $7 and $8 comes out to be $11.39. The cost of the project is $13.16, which means that I've got a profitability index of 0.87. If R is 5%, then the profitability index is 1.06. And the capital budgeting rule based on this is take the project if the profitability index is greater than 1. On the good news side, the profitability index capital budgeting rule often gives the same decision as the NPV rule. But it shares all the same problems of the internal rate of return. That is, it lacks the concept of project scale. Thus, higher profitability index projects are not necessarily better than lower profitability index projects. And the profitability index doesn't even have the main advantage of the internal rate of return, which is that you don't need to know what the cost of capital is. In order to compute it, you already need to know what the cost of capital is. Here's another one. The payback rule measures how long it takes to get your money back. It may well be the most common ad hoc rule that is around, and it simply says, take projects that have the shortest payback time. How could the payback rule possibly go wrong?
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay. Make up two projects. Project A pays back the money in the second year. Project B pays back the money in the third year, but it pays back a lot more money. In fact, that could be $2 million, and the payback rule would still tell you take project A. Now, when you're in an imperfect capital markets, where not everybody has the same information, it may not be altogether that useless, because having the cash flow uncertainty resolved sooner makes it more trustworthy. It also happens under those circumstances that it's harder for you to raise capital, because you're in an imperfect capital market, at the same cost of capital. So having money come in sooner actually helps you on the transaction costs, on the capital raising costs. Under those circumstances, payback is a little bit more useful. If you cannot trust your managers to provide a good estimate for far future cash flows, a nuclear power plant which will only be done in 10 years, and they always run over budget, typically 3 times over budget. Having a project, a reactor that pays back money sooner can be better. It's more difficult to deceive on short-term projects. But in an imperfect capital market, is the payback rule really the best one? Maybe, we don't know. There's also other ad hoc rules we could do, like we could use net present value with a higher discount rate. Maybe, we don't know. Depends on the situation, hard to tell, we don't know. Perfect capital markets are really wonderful. Now, does your capital budgeting rule even matter? If a project is extremely profitable or extremely unprofitable, most capital budgeting rules are going to give you the same recommendation. So many great projects will just say, bling, 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 yes, every capital budgeting rule. Many bad projects are going to just give you, no matter what capital budgeting rule you're going to take. Frankly, under those circumstances, you barely need a capital budgeting rule. It's when they conflict that you need a capital budgeting rule that's really good and correct. And only net present value comes with such a guarantee. Every other rule requires a prayer. So here's an interesting piece of information. Successful discotheques had a payback period of about half a year. How do I know this? Well, it turns out our family business when I grew up was running discotheques. I was not an academic up front. What does a payback period tell you about NPV? Well, for one is I can tell you that there were a good number of discotheques that never took off at all. So yeah, the ones that were successful paid back all their money within 6 months, but then you also had a bunch that never really worked that well. Maybe instead of thinking about payback period, you should be thinking about economics. Why is it that successful discotheques had a payback period of half a year? What kind of businesses have short payback periods? What kind of businesses are highly profitable? What are economic rents? So economic rents are the things that you get in excess of what other people, everybody can get from the public. And what creates economic rents? Those are far more interesting questions than contemplating payback periods. Here is what large firms in the real world use for their capital budgeting rules. Clearly, net present value and internal rate of return are dominant. The payback rule also plays a big role, and that's a little bit strange here because large firms usually live in fairly perfect capital markets. Some firms use accounting rate of return. Now that's completely crazy. I know you're taking an accounting class, but the book value of equity is really a funny number and doesn't mean very much. So calculating a rate of return on this means even less. Another rule is comparables, comps, and we are going to describe them later on in the book. Profitability, the profitability index that I just showed you, that is used not as often, but it's still used in the real world. 39% is nothing to sneer about. What about small firms? Well, small firms live in a more imperfect capital markets. It's very hard for them to raise more funding. So they tend to use more payback, which is to an extent understandable. They also use the accounting rate of return. Well, fortunately, I don't have much hair because I would pull my hair out. They use comps 40% of the time, which for some firms also makes sense because if you think about this, how do you value a biotech firm that doesn't have sales or revenues, much less profits? So you can only value it relative to its comparables. That's why many times they use comparables. NPV and IRR now only have 40% of the time. And my guess is there are some that are doing no financial analysis whatsoever. Not a great idea. And a recipe for disaster. Some of the things that I have omitted are scenario analysis, real options, which is used in the context of energy, oil, wells, electricity, all kinds of aspects like that. Gold. Then there's also simulations. This is already more rare, and something called adjusted present value, which is also rare. That's it for this video, for Chapter 4 and for capital budgeting rules. The obvious best advice in scenarios anywhere close to our perfect capital markets is to use net present value. That's it. In our next chapter, we look at our first generalization of our simplest world scenario, the first of many. We are going to think about a world in which costs of capital, that is interest rates, can depend on the horizon, as they usually do. Well, okay, I mentioned this situation already just briefly in the context of the internal rate of return, so it shouldn't be a total surprise. See you soon. Bis bald. Did you hear about the court sentence about the pen thief?
No.
Payback's a bick.
Guess what I can be?
A bick?